Hey everybody, and Happy New Year. This is Jason Bronchetti, the Chief Investment Officer at Lincoln Financial Group, and I'm excited to kick off 2024 with another look at three key themes on the mind of investors using visuals from our flagship market chart book, the Market Intel Exchange. The first theme on the mind of investors is the incredible resiliency of the U.S. economy in 2023 and questions around whether or not it will continue. A year ago, we highlighted the staggering number of economists who predicted that the U.S. would enter a recession within the next 12 months, more than any other time in history. At the same time, we also laid out a case that the economic picture may not have been as clear as the headlines were leading many to believe. As we know, 2023 turned out to be a very humbling year for forecasters. Inflation continued its orderly decline, with the consumer price index close to 3%, while high interest rates proved to be no match for the American consumer, who continued to catalyze economic growth through robust spending. As we enter 2024, there are signs this resiliency may continue, at least in the immediate term. Within the Market Intel Exchange, we've created a dashboard of economic indicators to help visualize current and expected trends. We'll likely see disinflation continue throughout the year, though perhaps at a slower pace, and while forecasts for economic growth in 2024 remain positive following last year's strong results, it's likely to moderate moving forward. Meanwhile, both the labor market and consumers have held up nicely to this point. Unemployment is still near record lows, and spending has proven resilient, and household debt servicing ratios remain modest. However, as we discussed last quarter, there are some emerging signs for caution, like increasing credit card delinquencies and speculative grade bond defaults. These are things that are worth monitoring as we move forward. Also, it's important to remember that the biggest risks to the economy are often the ones that we don't see coming. For example, an acute rise in geopolitical tensions could change this picture overnight. That's why, when it comes to long-term financial planning, we believe, as author Nassim Taleb once said, invest in preparedness, not prediction. The second theme on the mind of investors is the impact of a Fed pivot and what it could mean for markets. We've been talking about inflation rolling over and peak interest rates for the better part of a year, so it feels like a bit of a breath of fresh air to begin thinking about what the next part of the cycle could look like when the Fed ultimately begins cutting rates. The FOMC's December dot plot signaled that 3 25 basis point cuts are likely this year. Market participants are even more aggressive, pricing in as many as 6 25 basis point cuts, with the first projected to happen in March. Either way, both parties agree that rate cuts are on the horizon. So what could this mean for the stock market? Well, using previous cycles, history shows that in the 12 months following the first rate cut, stocks have, on average, delivered positive, albeit relatively muted returns of around 5%, or roughly half the historical return of the S&P 500. However, digging deeper into the results shows that in these scenarios, as goes the economy, so goes the markets. We naturally tend to think of periods in which the Fed makes cuts as being associated with weakening economic data and an impending recession. But as the data shows, this isn't always the case. Going back to 1965, when the economy fell into a recession, within 12 months of the first cut, the market followed suit, falling on average around 3%. However, when a soft landing was achieved and a recession was avoided during those first 12 months, returns were well above average at a robust 15%. This is a stark difference between these two scenarios, so it will be important to continue to watch the economic data closely. The third theme on the mind of investors is the presidential election and its potential impact on the markets. Elections bring with them the one thing that market participants tend to dislike more than anything else: uncertainty. However, history shows that election results don't typically impact long-term returns, regardless of which party wins. These visuals from our partners at Capital Group do a great job of laying out the historical context. As the light blue line on the left shows, early in the election years, uncertainty during the primaries all the way through the election days tends to bring volatility and choppiness to the markets. However, once the results are in and that cloud of uncertainty is lifted, we've historically seen a strong uptrend in markets. Also of note is that the political party that wins the White House has had little to no impact on longer-term returns. Since 1936, 10-year annualized performance of the S&P 500 at the start of an election year has produced, on average, double-digit returns, regardless of whether a Democrat or a Republican emerged victorious. So as always, the best course of action for most investors is simply to stick to your long-term plan. So there you have it, 3 key themes on the minds of investors as we enter 2024. For more information and to access a comprehensive set of slides on the markets, I encourage you to check out the latest edition of Lincoln's Market Intel Exchange.